Richard Turnill is head of global equities at Blackrock Investment Management, and his team manages $12 billion. Thank you so much for joining us. In terms of this market volatility, Richard, it is set to continue until we have a clear definition, or at least some kind of clear solution, which we can't really imagine what that would be like at this point. I see.
Yeah, I think the markets are coming to terms with a much slower growth environment, and the trend for global growth is clearly downwards. We're seeing that most aggressively here in Europe, where it now seems likely we're actually in a European recession. Globally, things are holding up better than that, but I think the markets are looking for a decisive policy response to the deteriorating economic environment. And right now, not only are we not seeing the policy response, we're not seeing the path to that policy response.
But it seems that certain stocks, or in general certain indices, still seem to be very cheaply valued. So should investors be very wary of that and expect further falls, a huge correction in some of these indices, or would now be a good time to buy and scoop up some bargains?
Yeah, so when I look at global equities, then I think equities in aggregate are starting to look good value. I think the risk you face in many parts of the equity market is you've got very substantial earnings downgrades to come, and therefore your confidence as an investor that that value is going to be realized is low. The areas of the market I find very attractive now really fall into three categories. The first is quality. It's those areas of the market where you have confidence about the earnings outlook, even in what looks like it's going to be a very difficult economic environment going forward. The second is growth, and I think there still are some very attractive areas of growth around the world, some very attractive companies with growth industries and growth business models, which have fallen significantly over the last few weeks, and I think are now at very attractive valuations. And then the third, and perhaps the most important, is looking for companies which are returning capital to shareholders, either in the form of dividends or in the form of buybacks. And when I look at those type of companies, I find today really some extraordinary value appearing, particularly when compared to the valuations of other asset classes, which for long-term investors is very, very compelling. So those are the opportunities I think we should be buying into.
So Richard, you talk about quality, growth and capital. Is there any specific region that seems to be doing better than others in providing investors with those 3 points? It seems difficult to imagine that Western Europe and the periphery countries could do any of that.
Yes, I think it comes down to the stocks in particular. I think Europe is really struggling right now because of although the European stock market is truly international, I think the scale of the political crisis is starting to overwhelm all other factors. Although within Europe, we're certainly finding some very attractive international stocks in, for example, the telecom sector, in the industrial sector even, and in the healthcare sector. When we look for quality, interestingly, we find quality stocks really in most major markets. The US is an attractive source of high-quality businesses, high-quality management. So is Europe, and increasingly Asia. When we look for growth, however, actually increasingly we're looking east. And that's partly because that's where you're getting faster-growing economies, faster-growing markets, but it's also, in my view, where you're most likely to get the first policy response. So we talked about earlier, looking for that path to policy. And when I look around the world, Europe, it seems a long way from a decisive policy response. The US, we have major political issues and debate around what the right response is going to be. Asia is there. I think there's the greatest potential, actually, to respond to the crisis.
Richard, what about certain industry groups that look too expensive and too risky at the moment? I'm thinking of banks. They've been taking quite a beating, and we still don't really know what the end game is.
So personally, I would still try and avoid some of the most risky areas of the market. You've got a lot of financial stocks around the world now trading on attractive, like headline multiples now, trading at price to books well below 1. But the concern about all those stocks is really, you know the price is wrong, you just don't know which way. So stock trading on half times book, you know that's the wrong price, but those stocks are either going to go to zero or potentially 100% upside. And the outcome to that is really a political decision, and which is very hard as an investor to have insight into. I'd much rather focus on the areas where I do have insight, where I can see the value, and I can see really a very attractive and sustainable returns going forward. And the valuations of those stocks are compelling.
All right, interesting analysis. Richard, thank you. Richard Turnill there from BlackRock.